Congress just introduced a bill that would abolish the IRS, end our national income tax, and instead replace it with a national consumption tax. So in this video, we're going to look at what a change from an income tax system to a consumption tax system would look like, how it would go into effect, the pros and cons of each type of taxation, and of course, who has the most to gain and to lose with the potential switch. Be sure to hit the like button on this video. It's the only sure way to avoid an IRS audit. And now let's first quickly take a look at how our current income tax system works. Income tax, as you might be able to guess, means that we're taxed on the income we earn. Be that from the wages we earn at a job, dividends we earn from our investment, or just interest we earn in our bank account. And the income tax system we have in place here in the US is what they call a progressive income tax system. Basically what that means is the more money you make, the more in taxes you pay. And this is achieved through tax brackets. That's a term you're likely familiar with, but where a lot of people go really wrong when talking about taxes is understanding how tax brackets actually work. If, say, you're in the 24% tax bracket, you don't just take 24% and multiply it by the amount of money you earn to get the amount of tax you owe, because the tax brackets in the United States are what they call marginal tax brackets. Think of it this way. For 2023, there are 6 different income tax brackets, and we'll use the income for single filers just to keep it simple. For the first $11,000 of your income, you're taxed at a 10% rate. That means if you're an office worker making $50K a year, or if you're Elon Musk, we all get taxed at a 10% rate on the first $11,000 we earn. But what if you make more? For every dollar above $11,000, until you hit $44,725, you get taxed at a 12% rate on that money. Next, you get taxed at 22% for every dollar you earn up to $95,375 per year. Every dollar you earn above that until you hit $182,100 will be taxed at 24%. Then, it's 32% until you hit $231,250 per year. Anything above $231,250 per year is taxed at 35%. So if you make $250,000 a year, maybe that much of your income is falling into the 35% tax bracket. Even if you make a lot more than that, you just keep filling up that 35% tax bracket where, unlike this cup, it will never overflow. It gets more complex with deductions and tax credits, but that's the gist of it. And that's vodka. That's the same basic system we've had for 100 years now. The number of brackets, the rate of each bracket, and the income required to be in each bracket has fluctuated over time, but the structure of the system has remained fairly the same. It has its faults for sure. Some people would say the poor don't pay enough under this system. Others would say it's nuts someone making $250,000 pays the same tax rate as someone making $10 million. But that's a whole nother video. The new proposal is to change the country away from this income tax system and over to a consumption tax system. So what is that? And how does it work? And I couldn't think of a good way to illustrate a consumption tax system for you, so I'm just going to have to lay it out. Essentially, a consumption tax system is exactly what it sounds like. People get taxed when they consume, when they spend their money. So no longer would you be taxed on the money you make at your job, the investment returns you earn, or even the interest on your savings account. Instead, you'd pay a national consumption tax every time you bought groceries, got a new iPhone, bought a car, or generally spent money in any other manner. There are a number of countries around the world that have a consumption tax system like this in place. It's usually called something like a value-added tax, or VAT. However, in all of these places, the consumption tax acts as a supplement to the national income tax, not a replacement for it. You may be saying, Jay, this just sounds like sales tax. What's the big deal? And you'd be right and wrong in calling it sales tax. You see, plenty of states in the US already have a sales tax. including New York, where I live. But with the sales tax system we're currently familiar with, those taxes tend to omit your basic necessities from being taxed. Like here in New York, things like groceries, medicine, healthcare related items, and most clothing under a certain price point, and a variety of other basic needs and essentials are exempt from being charged any state sales tax. And for a consumption tax to work at a national level, especially as a replacement for an income tax, you're probably going to need to tax all forms of consumption. The United States collected $289 billion in individual income taxes last year, making up for 51% of all government revenue. And that's a lot of money to replace. And whether we like it or not, the government does need to bring in revenue and bring in taxes to provide even the most basic of necessities that we all rely on public funding for. So I don't know exactly what tax rate is being proposed in this new consumption tax bill, but to replace that amount of revenue, we've got to think it's not going to be just 1 or 2%. It might have to be a hefty number. But that's just speculation for now. Why do so many people support a consumption tax model over our traditional income tax model? And the argument you'll hear from most people who favor the consumption tax, including many of the members of Congress that have written and are proposing this bill, say that a consumption tax rewards savings and it rewards having good financial habits. The more money I save, the more of my money I keep, the less tax I pay. The more money I spend and the more money I waste, the more tax I'm paying. And on the surface level, that seems fair, right? Everyone is only taxed on what they spend, and you get rewarded for having the good financial habits of saving and investing your money, right? And that's where some of the problems of the consumption tax model start to creep in. Once you start looking at it beyond the surface level, beyond the headline level. And the most common argument you'll hear against a consumption tax model is that it's a regressive system. Now, if you remember, our income tax model is progressive, meaning that as you move up the income scale, the more tax you'll pay. The consumption tax being regressive means that it will hit the low and middle income people the hardest. So you'd be increasing the tax burden on the people who are already struggling financially. And it's really just basic math. The people who make less money need to spend a higher percentage of their overall income just to buy the necessities and the essentials for them and their families. Food, clothing, housing, etc. These kind of essentials are just going to make up a larger portion of someone's overall income on the bottom of the ladder versus someone at the top end of the income scale. And there's really no way around that while maintaining the simplicity that proponents of a consumption tax claim the system will bring. Right now, we have all sorts of deductions and tax credits, etc. You likely don't owe any federal income tax until your income is in the 20s or 30,000s. With a consumption tax, you'd be paying tax from your very first dollar because you have to spend just to live. So a consumption tax will greatly benefit a wealthy household just by the fact that it's easier for them to reduce their spending to pay less tax because much more of that spending is completely optional. And there's another group that would get hit really hard by a consumption tax that many people might not even think about or consider, and that's retirees. To retirees who are no longer earning an income and probably don't have the capability to go back to work even if they wanted to, a consumption tax is just like immediate, permanent inflation. Imagine you're just settling into retirement, you spent your entire working career saving and investing your money, trying to get to your retirement number that'll allow you to live off a comfortable amount of income for the rest of your life. And now, all of a sudden, one day, everything is 10 to 15% more expensive and will stay that way forever. Say what you will about today's inflation rates, but at least we know they're not hanging around forever. There are plenty of other aspects of our society that may not enjoy switching to a consumption tax either. Charities may not like people losing the charitable contribution deduction. Maybe people will be less incentivized to donate money to charities. But proponents of the new bill and a consumption tax in general say that this system is simpler and fairer to everybody than our current system. And I guess that depends on your point of view. Is our current tax system broken because too many people on the bottom end of the scale aren't paying enough tax? Or is our current tax system broken because the progression of those tax brackets stops applying to any money earned over an upper middle class income? And all I'm gonna say is thanks for watching.